So we will start. I will have a very short, brief introduction, and then we will start our today's workshop. So my name is Vartuhi Andreasyan, and I am a business counseling manager at PACE Business Development Center. And I would like to start this session by thanking Citibank for partnering with us on today's workshop. And thank you all for joining us. We truly appreciate your time and participation. So before we begin, I would like to introduce PACE. PACE is a nonprofit community development organization, and we are proudly celebrating our 50 years of service this year. So PACE offers different services. It includes early childhood education, employment programs, energy initiatives, and business development center, and much more. So I am from Business Development Center. So at PACE Business Development Center, we offer services through Southern California. And under the city of Los Angeles, there are 10 BusinessSource Centers, and PACE operates 2 of them, one of which I manage is in Hollywood region. So our services include business counseling, procurement assistance, and access to capital. We also are an SBA lender, EDA lender, iBank lender, and a certified CDFI. So now turning to today's workshop. Again, it is like I would like to thank you again, Citibank, for this wonderful opportunity to collaborate together. And I would like to introduce our guest presenter, Saloni Radatia. Saloni is a young, as you can see, sharp and passionate professional who brings a heart to everything she does. I know you will enjoy learning, from her today. We had, past sessions with her, and she did amazing. So I would suggest everyone take this opportunity, listen carefully, take the notes, and we will have, we will wrap our session with a Q&A session. So please write your, questions in Q&A box, and we will go through all the questions at the end. So without further ado, I would like to hand it over to Saloni to get this session started. Thank you again, and I'm hoping that everyone will enjoy the workshop. Thank you.
Thank you, Vartuhi, for the introduction. Hi, everyone. I'm Saloni. I am currently a senior analyst in the healthcare corporate banking team here at Citi. This is my second year here, where I focus a lot on credit underwriting and risk management, super relevant to the topic that we will be discussing today throughout the webinar. And I focus on a lot of corporations, specifically healthcare, to really just evaluate the creditworthiness of all the clients and kind of helping them secure like financing as they think about their capital structure. And being in this role has really kind of helped me understand like how important credit serves as kind of like a financial tool, not just for corporations, but also for us as individuals, us as maybe like entrepreneurs, small businesses trying to borrow money or even just access goods and services with the promise of kind of, repaying it in the future. But excited to be speaking with you all today. And before we get started, if Annabelle, you wanted to introduce yourself as well, and then I can kick off the session.
Sure. Sorry, there I am. Hi, everybody. Thank you for joining the call. My name is Annabelle Santamaria. I am Saloni's colleague. I work for the Community Relations Group here at Citi. So I work very closely with community partners like PACE and wonderful partners like Vartuhi to bring you these educational sessions. So it's my pleasure to, witness Saloni in this presentation again. Vartuhi is not lying when she says she's dedicated and passionate. This is not her first rodeo, you guys, so you are in for a treat. And thank you, Saloni, for your time today. Back to you.
Of course. Thank you both. Let me go ahead and share my screen So it's just kind of easier to go through it, and feel free to stop me at any point if you have any questions or if you have any topics that you would like me to kind of dive a little bit more deeper into. Um, but just to kind of lay it out, the agenda kind of covers 5 different sections that we'll be going towards. A being just a general bigger picture of like what credit reporting is and what that means for your small business. Section 2 kind of diving into what is the impact of personal credit on your business, and then eventually talking about like how that differs from business credit, what are kind of like the differences, things to keep in mind, and from like a lender's perspective, what are some of the things that they do keep in mind when they are evaluating your creditworthiness. And lastly, just some resources, some tips to kind of delve a little bit deeper into what that means for like your business and also just maintaining like a good credit as an individual. Here's just some things that dive into detail. And before I kick off, if anyone wants to kind of just raise their hands and, just kind of mention any specific topics or something that they do currently know that they want to just share with the audience, like feel free to just unmute yourself or raise your hand if they want to share with the audience. I'll give it like 30 seconds.
Please feel free to raise your hand, and I will unmute you to ask, to share your the information.
Well, that's fine. Well, I'll check back in later at the end of the session once we go through a lot of these topics. But um, so to start off, right, like when I think about credit, what is it, right? Like it is essentially a financial tool that kind of allows individuals and businesses to borrow money or access any sorts of like goods or services that you're trying to utilize to grow your business with the promise of kind of repayment in the future, right? And the way I like to think about it is it really serves as a measure of trust and reliability in managing all these like obligations, right? And for maintaining, especially for small businesses, I think maintaining good credit is fundamental for like sustaining any sorts of your operations, expanding, or even just weathering any financial challenges that come. And building credit involves there's a lot of different processes to it, right? Like you have to be responsibly managing your credit accounts, you have to be making timely payments and demonstrating just the consistent ability to repay debt. And conversely, obviously, if you do have poor credit, you will see that reflected in the limited access of financing you have, increasing borrowing costs and just hindering like growth opportunities. Um, and a very, I guess, like easy example to like put this into perspective is just like, let's say someone owns like a small bakery. If you're consistently paying your suppliers on time and keeping your debt under control, like you're going to be able to easily build a strong credit reputation, right? So it makes things easier. And like I mentioned before, I do the same, I'm in the same role, but just for corporations. And that's like one of the things that we notice is that they do come to us almost every year every so often to like ask for different sorts of credit. And the way we kind of monitor that is by maintaining like a review of seeing like how the business is performing, how good have they been in kind of paying back that debt to us. Moving on, this section kind of dives into why credit reporting agencies are important to your business, right? And they play a pivotal role in the financial ecosystem, right? And they provide valuable information about you, your business, and anything related to your creditworthiness. And these agencies, they kind of gather data from various sources. So that all of this data comes from like banks, credit card companies, lender to kind of compile this comprehensive credit report related to you or your business. And these reports include details about like any entities like borrowing and repayment history, outstanding debts, and any sort of like unusual or usual financial behaviors to kind of have it in writing. And for small businesses, like these serve as kind of like a centralized source of information that lenders use to assess like any type of credit risk when they are considering loan applications. And this is why credit reporting agencies are so important, because by accessing this data, lenders can make informed decisions about extending credit, determining like what interest rates they would want you to lend the money at, and also just setting favorable terms and conditions. So we kind of talked on the definition of credit, and that brings us to our next kind of two different types of credit, right? And this is really important in the earlier stages, especially when you're thinking about like why it's important to kind of draw a line or have that boundary between personal and business credit. And personal, obviously, is everything related to you, your financial activities, your personal loans, your credit cards, your mortgage payments, etc. Business, on the other hand, it focuses a lot on like financial performance and obligations of like the entity itself, right? And while one can definitely influence the other, right? Establishing separate business credit is super important for protecting personal assets and fostering the growth of your business. You don't want to be in a situation where your personal like assets are held online. And building strong business credit does involve like opening accounts in the company's name, making payments on time, and also just maintaining like a positive financial record. Um, and that brings us to a very, this page kind of lays out a super quick snapshot on what a simple cycle looks like and why it's important to have that credit for a business, right? Um, Step one is definitely like accessing financing, right? You get the capital right based on your credit and your past historical performance. The next thing you would think of once you have that money or you have those proceeds, it's okay, I am thinking of acquiring or like manufacturing like any inventory, right? You purchase it and you eventually start managing your working capital. And as any small business, a business needs cash to cover kind of like its daily operations, whether that is payrolls, rent, inventory, etc. Or even just things as like accounts receivables, like inventory, etc. So that's when this cycle really helps you understand like why it's so important to have that credit in the earlier stages. And this is kind of like a spectrum that talks about, although both of the credits, personal versus business, they lie on the opposite spectrums, they can influence each other. And before you have like a business established, your personal credit matters a lot because that's what lenders are focused on, right? Like that would be their kind of data point to assess you, to build that trust, reliability, etc. And then obviously as you grow, your business credit becomes increasingly important. And that's why you'll see that for a lot of the startups, like emerging businesses, they would have to rely a lot on personal credit as the business is established, because that would be kind of the point in contact for lenders to assess that first stage of trust. And before we go into the next section, just a couple of like questions, like have you applied for any lines of credit in the past? Like what information documentation did the lender kind of obtain a request from you? And did the lender tell you if he or she would need your credit or like check your credit history if anyone wants to kind of participate and maybe just answer if they've been in a situation and wants to kind of educate the audience as well? All right, sounds good. So let's move on to the next section, which essentially tells you what a credit report is and what it tells the lenders when they have the credit report like accessible, right? It tells the lenders who you are, how much debt you have right now, for how long you've had it, how frequently you've applied for the credit, how much credit you're using, whether you're making the payments on time or not, and if there's any unusual financial behaviors, maybe a lot of like excess like deposits or just like negative information related to like bankruptcies, foreclosures, etc. This is kind of like a way for them to assess what how much trust or reliability they have. And when we think about the previous couple of questions that I put it out in front of the audience, a lot of the documentation does revolve when it relates to business credit around like financial statements, like tax reports, bank statements, legal documents, business plan, etc., for them to get like a holistic view of where your business is in standing currently. So this brings us to our major three credit reporting agencies, right? And these are, I'll kind of go into a little bit detail on all the three, but they're also kind of called like the credit bureaus, and they're the key players in the credit system. As we talked earlier, they collect and maintain a lot of the consumer credit information. And the three main in the US are Equifax. This is, I would say, one of the oldest and the largest credit reporting agencies, and it provides the credit reports, credit scores, and just like credit monitoring services to both consumers and businesses. Um, it does gather all of this credit data from like various sources, whether that's through lenders, through banks, or through public records. And this includes a lot of like your payment history, your credit utilization, the length of your credit history, and more. And there's a lot of similarities between all the three. Like a lot of it revolves around like providing like identity theft services, right? And this is to make sure that you as a consumer are protected, and also a lot of like other business credit services, like including credit reports and risk management tools. Similarly, Experian as well, it collects a lot of the data on like consumer like credit behavior, kind of like explaining you and like giving you and calculating the credit scores, etc. And just to kind of help you understand and manage credit risk and prevent fraud. TransUnion as well offers a lot of the similar services as the other two. And how these agencies kind of impact consumers and businesses, I think, is a more important discussion to have. And these agencies, they provide like credit reports, right? And they summarize like an individual's credit history, including information on any sort of credit accounts that you may have, credit inquiries, and any public records, all of your credit scores, that lenders use to assess like the credit risk, and also alerting you as a consumer of any potential like fraud or identity theft. Um, the other good thing about these agencies is also that if there is an inaccuracy or a discrepancy in your credit report, you are allowed to dispute it, right? And by law, the agencies must investigate and kind of correct these errors. And that's why it becomes really important for you to pay attention to these credit reports, because you want to make sure that there's no wrong information, because it's all related to you and your business and kind of goes hand in hand with your reputation as well. So this is what helps you understand like your credit health and really enables you and your business to make those like informed lending decisions. Um, So regularly checking these credit reports from these agencies can kind of help you maintain like a good credit standing and catch any discrepancies that you might see early on. And that brings us to like kind of what are the components of these credit information. So as you'll see, a lot of the examples on the slide is what you'll find on that report, right? It also goes into a lot of like the closed credit accounts, like what are the one-off charged accounts, um, any sort of like hard inquiries, or just like account information, whether you're married or not, etc. And this is where it's important to note that these are things that you should not be seeing on the credit report. Just like any sort of checking and saving account balances, your income, medical history, race, gender, marital status, etc., are just not something that should be on the credit report. Um, and then I think the last thing would be brings us to a credit score, right? And while this is not technically a part of the credit report itself, it's often provided when you do request your report. And it's kind of like a numerical representation of your creditworthiness, typically ranging from, say, 300 to 850. Obviously, with a higher score indicating a better credit, right? So you'll just kind of see that 750 is obviously showcasing a lot stronger credit score than the one that's a 520. And the way these numerical representations are assigned is through a lot of the different like score models that you'll see. And some of the lenders also are open to using their own credit score models, which might give them like a better sense of like where they see you compared to like where the other score models are kind of ranking you. Um, so this is where it brings you to the different types of like FICO, or I guess just like based on your credit report, what are some of the things that affect these scores, right? And your past payment history when you're looking at kind of like the two comparing just like the score factors, um, every factor is assigned kind of like a percentage weight. So payment history is 35%, right? So that has been given the most amount of weight, and that's because consistently paying your bills on time positively impacts our score. Late payments, obviously missing payments or making any sort of late payments can significantly lower your score. Um, and then when it comes to like the extreme ends of like severe delinquencies, such as defaults or bankruptcies, that have a substantial negative impact. And then you go on to like the amounts owed, which is your actual credit utilization, and that has been weighed about 30%. So this ratio compares your current credit balances to your total credit limits. And keeping your credit utilization below 30% is generally considered good. High balances can definitely like negatively affect your score. So that's also something to keep in mind. Length of credit history, it provides a lot more data on your borrowing behavior. The average age of all your accounts also equally matter, about 15%. And then new credit is applying for new credit can result in like hard inquiries sometimes, which may be temporarily lower your score. And opening obviously multiple new accounts in a short period can be seen as like a risky behavior and just be maybe flagged. And then the types of credit also has a 10% weight in the score model where it describes having a variety of credit types. So you don't want to put all your eggs in the same basket. So having like credit cards, mortgages, auto loans, etc., just kind of diversifying that can positively influence your score as it can show that you're able to manage different types of credits responsibly. And then when we talk about the Vantage score model, it was one of the credit scoring model that was developed by Equifax, Experian, and TransUnion. Um, it was used as an alternative to FICO, and it had kind of like a similar scale between 300 to 850, um, indicating a higher score. Meaning better creditworthiness, and would also take into account similar factors such as payment history, credit utilization, length of credit history, etc. Um, and this has been updated quite a lot, reflecting changes in like consumer credit behavior. And the latest version is, I think, the Vantage Score 4.0. This is also increasingly used by lenders, especially for consumers with limited credit histories, and it's also used a lot for like educational purposes and credit monitoring services. Um, and I think the one thing to note is that scoring is consistent across like all three major credit bureaus, and it provides tools to kind of help just consumer understand and improve like where is it that I'm lacking for me to like able to improve my credit score. And this kind of just shows a quick little diagram of how on the scale of 300 to 850, the excellent credit are the ones who are low risk borrowers and they're eligible for the best rates and terms and credit products. So you will find that capital for a lot cheaper compared to if you were on the left side of the spectrum with a 350 score. You're more likely to be denied credit, and that just shows high risk. And that's obviously, again, all tied to like your payment histories and how good your personal credit score is if you're someone who's still like just starting out. And all the three agencies do a great job in kind of sending you across like that one free personal credit report every 12 months. Um, and you can just easily access that through this website to just review your credit and be up to date on any changes and to flag anything that you might see is not accurate, right? Um, so the other thing is to just make sure, as I mentioned before, to get these reports regularly and just to review them for accuracy and disputing them when you see an error. That brings us to our next, the Fair Credit Reporting Act, right? Um, so imagine, for example, Sarah wants to check like her credit report to see what information creditors are using to value it, right? Under the following reporting act, she can request a free copy of her credit report from each of the credit bureaus as we talked about. Excuse me. And then say, for example, John discovers an error on his credit report, a credit card account that say he never opened, right? Under this, again, he has the right to dispute this inaccurate information with the credit reporting agencies, which must investigate the dispute and correct any errors that might have been part of it. It focuses on privacy. Say, for example, Mike applies for a car loan and the lenders check his credit report to make a lending decision. The lender must have permissible purpose under the Fair Credit Reporting Act to access Mike's credit report, such as for evaluating credit applications, right? Like you want to also make sure that this is all information that's very private to you and your business, and you're not just sending it out to anyone random. And then adverse action notices. I think a quick example that I can think of is Emily applies for, say, like a mortgage, but is denied based on her information in her credit report. Under the Reporting Act, the lender must provide Emily with kind of like an adverse action notice, informing her of the denial and providing details on how to obtain her credit report and dispute any inaccuracies. And then lastly, I think um, identity theft. I think, say, for example, your identity is stolen and fraudulent accounts are opened under your name. Under the same reporting act, again, he can place a fraud alert or a security freeze on his credit report, just prevent any further unauthorized access to his credit information. So that's kind of like why these reporting acts and regulations were put in place to ensure that no one's taking benefit and lenders and businesses are here to like kind of help each other and um, have the rights to kind of like from their perspective access your credit reports and from your perspective to like dispute any information and to have it within your rights to make sure that the information that is being shared is also being consented to. Um, I'll stop right here to see if we have any questions. And here's also a little sample of like what a personal credit report looks like. And I'll give like 30 seconds to quickly skim through and just stop here if you guys have any questions.
There was like two, Bobby shared that he applied for a business loan with his bank, but they denied it because they said the amount was very small for the bank. I am not sure what bank it was, but my assumption on this case is like banks also have different when it comes to the business and business lending, they have different programs. So it may happen that the program they had, it didn't, cover certain like applications. I am not sure. I'm just, assuming because the information is very limited. So do you or Annabelle have anything in regards of this that, banks may deny because the amount is small?
I think I can provide a little bit of context here. Obviously we don't have like the full details here, but essentially banks in general, they do incur like fixed costs when you're underwriting like a loan, right? Like whether that's documentation, legal work, etc. And for small loan amounts, if I understood that correctly, the cost of processing and managing the loan itself may outweigh the interest income that the bank gets. So they may decline like smaller requests. And I think this also depends on the size of the bank, like regional versus like a bulge bracket. And some banks might also just have specific programs related to what qualifies under what, if I'm not wrong.
I agree with you. There are like different aspects when it comes to the lending, which may it should be analyzed from that perspective. So at this case, the request, I just see that you mentioned that it was 10 to 15,000 dollar, and he ended up to getting the equipment lease instead of a loan, which I hope that the terms was better with the lease. There was another question in regards of at what point do lenders look more at the business finances than the owners? So I wrote a response on that case because we are a lender, so we look on both business and personal owners' finances. So I mentioned that if it's new, the business is new, definitely the lender, of course, the traditional banks, they don't do the new businesses, startups, but even like for the lenders like us, CDFIs, we look on the business, cash flow, business, financial, how strong it is, but also we look on the owners, background and background meaning financial background, like what is there. And if the business is more established and more profitable, still, for the small businesses, that it may not play a big role, but still the owners' financials is important because it helps them, the underwriting team, for the risk assessment and risk review. So always keep it in mind that both are important. If you want to add anything, please, just Saloni, just
Yeah,
add.
no, of course. I think that's exactly very spot on. Something that I was gonna say, I think the timeline of the business is very important if it's obviously something that we talked about, right? Like a very established new business with say less than like a year of history, lenders mostly rely on personal credit because at that point in time you don't have those established financials. Versus obviously like if you've been in the business for say more than 2 years, they kind of start focusing on to the business financial, just like tax returns, like your profit and loss statements, etc. But um, that's exactly what Virtue kind of alluded to.
Yeah. Thank you. I guess we don't have any comments or questions at this point.
All right, no worries. We can keep going. So here are some best practices, right? Building a strong personal credit is very important for financial stability and flexibility. And here are just like some of the very high level practices to kind of keep in mind. So A would be paying your bills on time. this is, I think, the most important, as we also saw with the credit score model, where this is something that was rated the highest, right? Timely payments are super important. Maybe just set up like reminders or even just enroll in like automated payments to just ensure that you're never missing a due date. I think personally for me, automatic payments work the best, just because I don't need to keep reminding myself or don't need to keep putting reminders. It's just that one day before it's due that I probably just have that automatic enrolled. Um, the other would be keeping your credit card balances low relative to your limits. You might have a higher limit, doesn't mean that you're expected to kind of utilize all of it. Aiming to pay off any balances in full each month to kind of avoid that accruing interests and to demonstrate like responsible like credit management. Um, Only apply for credit when necessary and avoid opening multiple new accounts within kind of like a short period of time, because each new application will generate a hard inquiry on your credit report, which can temporarily like lower your score. Um, and then diversify your credit, right? Having a lot of different mix of credit types, such as credit cards, installment loans, mortgage, can kind of positively impact your credit score. And regularly check your credit reports from all the three major credit bureaus, as we talked about earlier, Equifax, Experian, and TransUnion, to kind of just ensure accuracy, and you don't want to be just left in the dark and detect like any suspicious activities or error when it's too late. And then when you do find those errors, just make sure to kind of dispute them. And also, y- I think one of the last like important things would be maintaining long-term relationships. So keeping your oldest credit accounts open and in good standing can really positively impact your credit score by demonstrating that you've had like a longer credit history, you've been committed to this account, you've been paying off your bills, etc. Um, and obviously you only keep them open if you're able to manage them responsibly. And I think last would be if I think a lot of times like not everything is as easy, like easier said than done, right? So if you are experiencing any financial difficulties or you are anticipating any trouble making payments in the future, please like contact your creditors proactively. There are more instances than not where they are willing to work with you to establish a payment plan or to just modify your terms to kind of help you restructure your debt so that you don't get into that loop of like negative credit reporting, because you don't want to be in a position where there's just no sort of communication and you're not able to pay off the debt, and that leads to kind of this whole cycle of like, your credit scores being affected, etc. I would rather just be proactive in letting them know that, hey, um, I have this like payment coming due, like I don't think I have the necessary funds available. Is there a way that we can work it off? Maybe push it off to 2 months. And if you have been one of the reliable people, creditors are more than willing to kind of, find some sort of like payment plan or modify some of the terms and conditions, given you've had been in like a good standing. Um, and then also just educate yourself, right? Like I think that's why financial literacy is so important, because you want to stay informed about credit management, just best practices and how all of these like credit scoring works. And this kind of helps you make informed decisions and just maintain a credit, like a strong credit profile. But that would be kind of like my best um, practices to keep in mind. And then now we move on to seeing how personal credit history is important for your business. And that's when you'll need a lot of the business plan, the loan getting approved. Um, in the earlier stages, obviously, it's your own personal assets that you're guaranteeing against your business. And then once the business is a little bit more established, you've had that record for like 1 to 2 years, it becomes easier to access that financing and just like having that credit to grow your business. Um, this brings us to our next section related to business credit reports. So we touched a lot on the personal credit reports, the type of information in it, etc. And this is everything related to kind of like what a business credit report does. Essentially the same thing to evaluate the risk of lending, extending trade credit, and just like contacting with your business. And you'll see that this is kind of like the difference in what goes into the report, right? Um, with the business credit report, it becomes a lot more important for you to have a higher level of detail, whether that's just business background, a lot of the registration, financial information, etc. And it has your business credit history and just like public record information. And similar to how we had Equifax, Experian, and TransUnion, for business credit reporting, you have Dun& Bradstreet, Equifax, and Experian as well. Um, right? And DNB has been a global leader in kind of business credit reporting services for a long time. It offers business credit reports, scores, and any sort of like analytics, and it covers kind of like the comprehensive database covering like millions of businesses worldwide, just to kind of help us in as someone who's handling a business make more informed decision. Um, this kind of goes into a little bit detail of what we talked about, just what are the types of information. And I would just kind of focus on the third column because that's something that's a little bit more different than what goes into your personal credit report, right? Your legal structure and ownership, I think, is a very important like aspect that goes into the business credit report that you don't usually see in your personal. And this is essentially for business is established as a S corp, as a C corp, as an LLC, etc. Um, so that's something to keep in mind. And then a lot of the FCRA that we talked about earlier, they don't apply technically to your business credit reporting. They have other kind of measures and procedures in place to provide like access to reports, just to manage disputes and just determining how long information stays on the report. So that would be kind of how these business credit reports provide like valuable insights on your business and just like how they're very different than a personal credit report. So here's kind of like a little bit of similarities, I would say, with your personal. When you look at the scores, they generally have similar ranges and they measure like a lot of the similar factors that we talked about related to payment history, how long the credits have been open for, etc. Versus the business ones, they focus on a variety of different scoring ranges and rating systems, and they do emphasize a little bit of more different factors that we'll go into in detail. Um, Same thing with DNB, just make sure to have an account. They use credit monitoring services to receive anything related to any movements related to your business credit score, etc. Some of the services are obviously free, and some of them come with a fee. So just something to keep in mind when you are looking to like establish that, right? Um, so next, you might just ask why even, I guess, think of establishing a business credit, right? Um, I think it's important because business credit really helps the lenders determine like approval in terms of financing. And this goes back to my point of if your business is not able to pay back those obligations, you want to have that good standing and relationship with the lenders, and that comes from your business credit, right? To really just make sure that you're able to negotiate like favorable terms and conditions for you to have the best offer, I guess. And to just decide whether to grant a deferral of payment for goods and services, whether you're trying to pay your suppliers or whether you're waiting on receiving like anything in your accounts receivables, etc. Just ensuring that your company is having a legal entity, and just evaluating your ability to like, you know, execute like any government contracts. Um, So the other thing I would say is it just makes it easier to establish relationships with vendors and suppliers, right? When you are trying to do that as an entrepreneur, you it may lead to better payment terms, discounts, and even access to like higher quality goods and services. Um, will build that credibility, will build that trustworthiness, and some insurance companies and landlords actually also consider business credit when they are settling up like a premium or lease term. So positive credit history may result in like a lower insurance premium for you or just like a favorable lease agreement, reducing all of the operating costs that your business is incurring. And then lastly, I would say obviously a good business credit, it really helps open the doors to expansion and growth opportunities. And it can facilitate access to like larger lines of credit, equipment financing, or investment capital, enabling your business to like pursue any strategic initiatives or just scale operations if you need. And then lastly, I would also say emergency preparedness. Establishing a business credit kind of provides a financial safety net for any of the unforeseen circumstances or emergencies. So it ensures your business has access to the credit you need, helping you weather any challenging times or seize any unexpected opportunities. So overall, very essential for stability, growth, and sustainability. Improves your access to financing, strengthens relationships, enhances credibility, and positions your business for long-term success. So let me move on to the next page. So in order to do that, I think step number one would just be to get that EIN number. If once you get that, definitely make sure to have it in a safe place, maybe as like a PDF that you have saved on your drive, anything. Um, and then ask the lenders and suppliers to kind of report information about you and self-report any financial incredible data as feasible. And we already talked about this, but a couple of the business practices that I would just make sure is to really maintain that healthy credit, having separate personal and business finances. I think this is more important than ever, just because you don't want your personal assets to be um, risked, right? And I think the other thing would be to just monitor them as you progress. And then this brings me to kind of my next question of how do you think having a healthy business credit report could help your business? If anyone wants to kind of take a step in the next 5 years, maybe how do you think having a healthy business report could help your business after everything that we've talked about, if somebody wanted to kind of just pitch in?
Anyone, if you want to speak, please let me know. Raise your hand and I can unmute you.
Okay, amazing. No worries. We'll get started on, I think, the last section, or maybe the one before that. But here's the current landscape of business credit reporting, right? And this kind of delves a little bit deeper into like small businesses being in the middle of the chart, having the lenders and businesses that use these reports, companies that provide the credit reporting, the scores, etc., and just kind of talks and gives like a high level like snapshot of like what this is. And putting it all together, you'll kind of see this lays it out really well. Um, and this is essentially what is a very important and unique term to use in credit, and that's the 5 C's of credit. And that talks about the capacity, the collateral, the credit history, the conditions, and character. And this just really dives a little bit deep into what is the capacity, right? Like how much capacity do you have to kind of like pay off? What is it that you're collateralizing it against? And this is when it becomes important to my previous point of establishing that separate personal and business credit. And that then goes into your credit history that talks about like what have you had in the past, um, to then like really, establishing that separate conditions in character. So this is kind of, let me see if I can find something that helps. Um, but I think the next page might have it. Yeah, so a lot of the times when lenders are looking at loan data, they're not just looking at the traditional loan data, right? They focus a lot on the non-traditional loan data as well. And this is typically like examples of your utilities, your telephone services, rental data, any online like business review for business credit, especially like any shipment volume, merchant account transactions, etc. And this is not as relevant as I would say the traditional data, but it's still used by a lot of the lenders to see and just help predict the risk that they will be in if they're lending to you or your business. And this brings us back to like what type of lender you are, right? Like every lender has different requirements, different priorities, and some might focus a lot on the traditional loan data versus some might focus on non-traditional loan data. Um, when you are looking for a startup loan, I think it's important to consider all the 5 C's of credit and just really emphasizing on credit and collateral because in order to have them secured, they want to make sure that there is something that backs them in case you're not able to pay that obligation. And just as a way of reference as well, we also sometimes deal with companies that might not have good credit, and that's when we'll have something as a collateral, which will have full rights to. So in the event that the company is not able to pay us back, we'll have like the first lien on that asset. And then, so we talked about, I'll go a little bit deeper into the non-traditional data. So this is essentially talking about any individual or business's payment history with non-credit accounts. So this is everything that's related not to the credit because everything related to credit will be considered, I guess, like traditional data. So your utility bills, any sort of rent payments, subscription services, these alternative payment data sources can kind of help provide valuable insights into like how you or your business like reliability and ability is to like meet these financial obligations. And a lot of the transaction data from bank accounts, including income and spending patterns, I think is also an important point where you're offering a comprehensive view of an individual or business's financial health, and also analyzing bank account information like allows lenders and credit agencies to like assess cash flow, income stability, spending behavior, and supplementing traditional credit data. I think one of the other things I would also, which is interesting, is social media and online activity. A lot of the times, social media profiles, online reviews, digital footprints provide insights into just like your the consumer behavior, preferences, reputation, etc. And this kind of helps assess an individual's or business credibility, trustworthiness, and potential credit risk. Um, Non-traditional lenders such as online lenders or I guess like peer-to-peer lending platforms, they gather and analyze alternative data to assess creditworthiness in making lending decisions, and this may include data on business performance, transaction history, or customer reviews that traditional lenders may not usually consider. Sometimes, which is like very rare, but mobile phone usage data, including like call patterns, location history, and app usage can also provide insights into like a person or like a business's behavior and financial habits. Um, and the non-traditional data sources can include employment and income verification services that provide um, real-time access to employment and just like income verification. And verifying employment and income data really helps lenders assess an individual's ability or a business's ability to repay loans or just meet those financial obligations. Um, and when you look at this page, again, different lenders, different priorities. Lenders offering, I guess, working capital loans, like loans which help you kind of fund your daily operations of the business, they place a significant emphasis on the business's credit history, including payment performance, overall creditworthiness, etc. And they may also sometimes consider the non-traditional data sources such as bank transaction, industry-specific metrics to assess the business's financial health and repayment capacity. Cash flow analysis also sometimes plays a crucial role in underwriting working capital loans. They evaluate the business's cash flow projections, revenue streams, um, and liquidity to determine its ability to generate sufficient funds to cover operating expenses and repay the loan. Um, Understanding the business's industry dynamics, market trends, competitive landscape is just so essential for assessing risk and just determining if you are or if you're not eligible for the loan. Um, yeah, I think lastly, I would say know your credit, know your lender, and know your rights. I think that would be the biggest thing to kind of take away from this. And this is just kind of going back to the credit reporting and like business operations, what it means for you to pay a small fee to like access these credit reports of consumers or other businesses, and the small business reports information such as any of the outstanding debt about consumers and etc. So here are just to kind of summarize, we're kind of approaching the mark, but just to kind of summarize the key points to remember, how important it is to establish a good credit, whether that's personal and business. If you are a small business owner looking to grow your business, just having a separate personal versus business credit history is super important. Um, and then lastly, accessing those credit reports, ensuring them for accuracy, flagging them for any disputes, and making sure that you're doing that in a timely manner to avoid any red flags, I guess, or just any sort of like public records. Like you don't want yourself or your business to be in bad light. Um, and then this kind of talks about the same thing. And yeah, I think that's pretty much the content of the materials. We can start taking questions now, or if anyone wants me to kind of go over a specific topic again, happy to.
Thank you, Saloni. Appreciate it. There was a lot of information there, valuable information, and I am sure everyone is going to benefit from this. So anyone, if you have a question, if you want to ask your question, or you need, to go back, if the Saloni should go back to a specific, section and repeat it, just let us know. There was one question asking about, is there a charge to join DNB or the other credit agencies for businesses? I responded back that as far as I know, if you just want to get the DUNS number, it is free. But if you want them to manage your credit, account, monitor it, so there is always a fee, attached to it. So it's better you go there and check with them to make sure like what is the expense, what kind of cost or fee is there. Saloni, is there anything you want to add on that?
Yeah, no, I think I agree. It's free to apply through like their official website to get like the DUNS number that Virtue mentioned. What might always good to like obviously check on their website, but what will cost money is usually paid services like credit monitoring, like business reports, or just like advanced like analytical tools that you might need. For example, like the credit builder program, I think is one of them that they have, but you do
Yes.
not need to pay to be included or to like begin building credit. If that's kind of where the question was headed towards.
Yes, thank you. And just to also share that when you asked about, how this credit is going to affect the business in a couple of years, Bobby shared that it will help to grow and scale the business, which is very, true. And at the end of the day, if you want to expand your business, if you want to grow your business, this is one important area that you have to be focused to manage your finances. your cash flow. For the business, the cash flow is the blood of the, the business. So you have to manage it carefully and make sure that you are on top of it. Let me see if there is any other question or anything. So I don't see any other question. Okay, there is one person who raised the hand. Let me see who is, okay. Let me allow. Okay, you can unmute yourself and ask your question. I am not sure if I'm spelling your name Kufre?
Yes,
correctly?
that's
Okay.
my name, Kufre. Good to see you guys. Sorry I came in late because I had some other things that are also important I was trying to take care of. I really wanted to be a part of this webinar because the topic resonated with me a lot. So if you guys wouldn't mind, maybe use just 1 or 2 minutes to give me a brief of the entire discussion in 1 minute, if that is too small or if that is too much. Please.
It is too, like, in 1 minute, it's really difficult to give you the like, but in a nutshell, as a business owner, you should manage your like personal finances, because it's important. As a person, as a business owner, it's important you will be on top of your finances, in top of your credit. Make sure that you are doing the things like pay your bills. This is like the message we always give, be on top. Same thing for your business. So make sure that you will be, you are managing your business finances very carefully, because at the end of the day, if you want to expand, if you want to, there was an example that if you want to buy equipment, you need finances. And to any lender you go, the first thing is that they want to look on your finances. That's the first question. How is your cash flow? How is your like income? What is like, do you have a profit or you have losses? So these are the things that they look, and as a business owner, you should be very, like on top of all this. Like, again, as a business owner on your personal side, you should be on top of the finances. We will have the recording of this session. I believe the previous recording is, it should be on our e-library. This one also will go on the e-library. Please go to our e-library and you can watch the whole session there. Okay?
Okay, thank you so much.
Thank you.
Is there any simple link to the e-library? Any simple link or something?
I will share it with you. Okay.
Okay, thank you.
Okay, thank you.
Thank you so much. Yeah.
Thank you. So let me see if there's any other question. I don't see any other question, or there is. Saloni, can you please share the, like the slides that I can share with the attendees, please?
Yeah, of course.
Yes, thank you. So that question is also answered. So if you don't have any more questions, I want to thank you all once again for your time being here, and participating. Thank you so much, Saloni. It's always good to have you here. I appreciate, your time. And, the way you present the topic, it's really, really interesting. And I love it. Thank you so much. And thank you, Annabelle, for being here with us. I really appreciate the collaboration we have. So I'm hoping that we will have more to come.
Thank you both again. This was such a great audience and great opportunity.
Thank you. Thank you.
Thank you, Fartuhi. You do all of the heavy lifting over at PACE to bring this programming to your clients, and we are just so grateful to be a part of it. So we appreciate you as well.
Thank you. Thank you. Thank you, everyone. Have a good rest of the day. Bye.
Thank you. Bye.
Bye-bye.